For the last 18 months or so, here at TabbFORUM, we've had a lot of conversations about collateral and collateral optimization. Given the changes in today's marketplace, it's understandable with Dodd-Frank and Basel III, there's been a lot of conversation about how institutions and market participants can optimize the use of the collateral to sort of adhere to the new market structure. Well, I think it's time for us to move beyond that conversation. I'm joined today by Chris Zingo from Calypso. Chris, I really want to talk to you about sort of a new concept that we're talking about, which is asset optimization. How folks can use assets to manage their business more effectively. I really want to focus our conversation about sort of the three-legged stool that exists in this area. Can you talk a little bit about that?
Sure. We call it the three legs of the tripod, the intersection between collateral, clearing, and liquidity. Right? Because at the end of the day, a lot of this market structure change that's creating opportunities has also created a lot of constraints for the organizations that we serve. Two major constraints. One is balance sheet. Right. Availability of balance sheet and the use of balance sheet for certain business purposes. And the second is cost. Right? It's getting more expensive to do traditional business. So our customers need to find creative ways to optimize the use of their assets to fulfill different business purposes at the enterprise level while maintaining cost control.
How are people in today's marketplace investing to sort of meet this sort of bifurcated need to sort of meet strategy requirements? Okay, I've got to grow my business, I've got to find new sources of alpha, I've got to make money, make profits. At the same time, I've got to manage this whole sort of trainload of regulatory change that's coming down the pike, not just from sort of the United States, but also in Europe and Asia. I mean, how are folks sort of adjusting to this marketplace? What are they doing?
Well, I think first is prioritization, and the prioritization one comes from the timelines, certain things that they have to do and have to be managing, and then other prioritization about what's practical, what they can actually achieve. The third level is, relative to their business strategy, what's going to have the most impact positively on the strategies that they put forward, right? So, for example, in a lot of our institutions on the banking side, the concern about, balance sheet scarcity and the constraints around their balance sheet is principal concern, right? So the first thing that they're looking to do is at an enterprise level, and when I say enterprise, I mean the global head of capital markets, the global head of FICC trading, is to understand what assets do I have available.
Isn't that a difficult conversation? Because historically, these institutions have been very fragmented on the sort of the interior, with each desk managing its own sort of capital reserve and its own sort of collateral reserve, and no one else can sort of have any transparency into it. How do folks bridge that to get more into this sort of broader thought process of asset optimization versus just managing my collateral?
Right. Well, absolutely. There are two elements there. There's one, the infrastructure to support it. Then there's also the business structure. Many of our clients' collateral processes are fragmented. They're aligned to the different businesses they support. Those pools of collateral are heavily guarded. Right.
Exactly. It's my collateral. Keep your hands off of it.
Exactly. So, at the broader level, if you're looking at, how do I cover this obligation and minimize the use of balance sheet in the process, or lower my overall cost of collateral, your options are limited. A, you can't see it. You don't know what's available.
Exactly.
And B, you're not optimizing the use for that required obligation. But you mentioned moving beyond collateral. I mean, at the end of the day, we call it asset optimization because the underlying collateral is an asset, right? Cash, security, etc. Those assets are used for a variety of business purposes. They're used to cover collateral obligations. Those same assets could be used to fund different business lines more optimally. Those same assets can be put to use.
Whether it's sec lending, and
repo, etc. That drives P&L profitability. So understanding what I have and understanding what I can do with those assets and how I optimize that use is a business purpose. It's not a specific function around collateral management.
I mean, this has got to be a huge question for the FCMs out there. They're under increasing pressure these days to try to drive returns and obtain greater profitability, yet the constraints they operate under are becoming greater and greater. I mean, this is a conversation directly targeted at them, or is it a larger conversation for the market as a whole?
Well, I think you can apply this, the same concept, the intersection of these three elements, clearing, collateral, liquidity, to serve different business purposes. So at the FCM level, what problems are they trying to solve today? Well, it's the whole operational element of supporting clearing for their customers,
right,
and what's required to actually support the life cycle of a clear transaction, which means they need an infrastructure, to take the trade in, look at the net new incremental risk exposure, calculate a VAR-based margin methodology, check the customer's collateral, all of those things that have to do affect the end-of-day transfers that come in from the CCPs. That's one element, but the other element, which we're seeing a lot, is the intersection of these three things in the context of intraday credit and liquidity risk management. Right? Because intraday, they're used to funding, margin intraday for their customers. It's becoming very costly to do so.
Exactly.
And it's very balance sheet intensive.
It's extremely balance sheet intensive, and that's going to limit its sort of viability as we move forward.
It's going to limit, it's going to limit the amount of clients that they fund, right? Because they're going to have to really start tiering, clients under preference in terms of revenue. But it also limits their ability to provide those services. So they're going to have to cut the clients off. And they need an infrastructure to know in real time, what that risk profile is. But not only what the exposure is, but what the underlying collateral in that customer's account is, with the appropriate haircuts, how much of that collateral they're willing to fund based on their liquidity threshold, and an infrastructure around risk that tells them, yes, you can support this client, no, you can't support that client. All in real time.
Is this a conversation that institutions can have in a short amount of time? I mean, this looks like a sort of a major change, a major structural sort of readjustment in the way they're doing things.
Yes.
This is not just, okay, we're going to move forward with this and it's going to get done. This is a slow evolving process, isn't it?
It is, and I think that's what I went back to, well, what are they tackling?
Right.
It's about prioritization. What's driving prioritization? Well, the first is regulatory timelines.
Gotcha.
So, the CFTC ruling 173 and 174, around the certainty of clearing requires that in real time you have to perform certain checks pre and post trade. So a lot of the investment right now is, how do I comply with this requirement, and how do I get my infrastructure expanded to support this? And then look beyond broadly, well, how can I leverage this now to better manage my liquidity risk intraday? Right, so the byproduct of complying gives you the opportunity to optimize the way you run your business.
And all this sort of leads to better use of your assets, which then increases your overall performance in the market.
Absolutely. And then you have those customers, especially the large clearing shop, that have large bilateral intermediation businesses, right? So their customers have bilateral exposures, they have cleared exposures. Looking at the customer at an enterprise level and managing these dynamics at the customer or enterprise level is an important element. So, from the FCM, you start expanding onto the broader enterprise on, how do I manage this customer? Gotcha. And then, you could apply that same concept to a treasury business that's centrally managing their funding and short-term, liquidity gap risk.
So it really is time for the marketplace to start moving beyond its sort of simple understanding of what the actual regulatory requirements are, and to start moving forward. Chris, I want to thank you very much for joining us here at TabbFORUM. I think we're going to be hearing more about sort of asset optimization, especially as the maturity level around these questions start to increase. Thank you.
Absolutely. Thank you, Alex.